Good morning, everybody. Welcome to the Flow Show, Tuesday, 8th of May. Sorry, Wednesday, 8th of May. Get myself tied in knots already. Hope you're doing well. Morning, Kay. How's it going, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, doing all right, doing all right.
Good,
And
good.
you? Everything fine?
Yep, all good, all good. Hopefully we get a bit of a busier day than we got yesterday. There was a bit of a brain number, that one, yesterday. But got a few moves going on today, so should keep us entertained. We'll get cracking right into it. BOJ's UEDA has been upsetting a few things overnight. In particular, he came out with some comments saying that monetary policy isn't meant to control FX. That says a policy response could be needed depending on FX impacts. Then he said in quite a market-moving comment, saying he doesn't see yen moves as having a big impact on trend inflation so far, but there is a risk impact could become significant in the future. That was a bit of a green light for yen sellers to come in and knock it back up again, because one of the things that they've been warning about is the possibility of the yen affecting inflation and or their monetary policy stance, but saying that it was doing nothing at the moment, saw us kick up through 155. He's gone on to say since then that if trend inflation moves as we project, we will adjust the degree of monetary support accordingly. Says risks are large on both sides for inflation, and there is a chance inflation may overshoot expectations. He has been talking a bit more about FX, how it could affect things, but it seems, Kay, the damage has already been done. And we've had Suzuki and the others coming out and giving their usual no comment on FX moves. Bit of a own goal by UEDA.
It's how should I call it? On the one hand, it's a difficult read because he seems to now firing those warning shots that they may do something if FX affects the prices. But the thing is, he doesn't. He says A but not B. I mean, where's the level? How much is it? We have got up. We can't forget that dollar yen went up 50%, right, in the past couple of or 3 years, which is a lot. So where is that pain level? I honestly don't know. Well, perhaps it's a bit longer than 3 years that dollar yen went up 50%. Did it? No. Where was it when? Oh, yeah, it was before the pandemic. Yeah. Anyway, I think he still has got this close cooperation with the government in mind. And after going to see Kishida yesterday, I suspect that they've been talking about that as well. And Kishida saying, don't forget that we need to sponsor, how much is it, 160 or so percent debt to GDP ratio. I'm just inventing a number, but it's huge. So he's trapped. I think the Bank of Japan is still trapped. They can do something because I think the economy would be all right with another 0.25% hike. But when is FX really going to affect inflation? UEDA is not clear at all on the back of it. So for me, right now, it's still a case of MOF is on its own if they want to curb the yen weakness, you know. On the other hand, and where he lacks to be vocal enough, is that we know that the Japanese whales are just waiting for them to hike more to bring more money back home potentially after having invested the pile of money that they are just sitting on right now. So I mean, there could be a double benefit if they hike the yields. 25 BPs it's going to cost the government, but it's still not going to put yields at levels where it's going to pain them a lot more. They are not going to have to pay up 3, 4, 5%, you know. So and if the Japanese whales they find it enough to bring some money home to invest back in JGBs, that will de facto strengthen the yen a little bit and do part of the job for as well the MOF and those who think that the yen is far too weak. Like we heard Keidan Ren, we heard the CEO of JAL the other day as well, complaining about the level. So that could do the job, but he doesn't seem to be ready to really proceed with it right now.
Yeah. Do you think that maybe all this FX talk that the BOJ are doing, do you think that's a bit of influence from the MOF? Because they were never this big on talking about FX before. You know, it's not as if the yen's only moved yesterday. You know, it's like it's been moving for the last 3-4 years. So why now are they big on FX? Is it they maybe had a nudge from the MOF to say, you know, start putting that in your comments or start reflecting on that a bit more?
Yeah, because I think that if it pushes up inflation, if the FX really pushes up inflation, it's going to hurt a lot of companies, consumer, probably everything. Although, well, it's especially going to hurt the street economy, as I call them, like the smaller companies, those who sell straight to the not to the, let's say, institutional consumer, but the local consumer. They have to pay more for the imports, but they are always very reluctant to pass on the prices to the consumer, to the street. So it is going to hurt. So I think the MOF must have done their homework and told the way that yeah, at least try to influence stuff a little bit and try to calm down this market a bit. We've seen what $50-60 billion of interventions are worth. If they in 2022 they got helped by a lower US inflation, but we are 2024 and we are higher than where we were then. So that's about how far in interventions bring you $50-60 billion. If you, let's say, I mean, and they for good order's sake they don't, but take only BlackRock, who manages over $1 trillion of assets, plus some assets for even GPIF and consorts, and for governments. Imagine that they go like, oh yeah, I want to fund 2 or 3% in yen. That's already $20-30 billion gone. You know, I mean,
Yeah.
$50-60 billion is actually on a world scale. If you look at even taking speculative hedge funds away from the picture, it's actually not that much. You're not going to stop or turn a market with it as well. And as you say, then rightfully, perhaps he's got a bit of an earful from other officials saying like, you really should come out and try to calm the nerves here, or this thing is going to trade 170 before you know it.
Yeah, exactly. We've been saying that since the intervention stuff happened. You know, it's going to have limited results unless they get a turn somewhere in the fundamentals, be it the US or in Japan. Otherwise, they could be, to coin a phrase, pissing into the wind for quite some time to come. But we shall see. They've got a decent enough ammo chest to pull from. So we'll have to see what they want to do. But so far, for the intervention, it's really only got on, 400, 500 pips better off than where they were when we were shooting up towards 160. So if that's worth your money, good luck to them. Anyway, we shall move on. We've had a bit
just
of
if I may,
yeah.
just if I may, the last thing since we've been working together, Ryan, we've been saying so often about Japan's missed opportunities, right? So the missed opportunities to start to raise rates a lot earlier, missed opportunities to stabilize the system, missed opportunities left, right, and center, and but also it's of their own doing, because remember Abenomics and the Corona period, they really wanted the yen to weaken. But I've got the sense of another missed opportunity last week where they were on the verge of putting perhaps succeeding of putting this dollar yen back under 150, and they missed that opportunity on Friday when it was trading 152. We know that they don't use data and stuff to do it, but if they really want to curb yen weakness, they had the perfect day then to put it under 150, and for some reason they didn't, because it was going down, so they didn't want to push it likely. But it's again a missed opportunity, right?
Yeah. Yeah, absolutely. And like you say, they could have knocked it under 150, put a bit of a lid there. Not said it was a cap or anything, but just put a bit of a lid there.
Scare speculators away.
Yeah, scare speculators away. Say, right, here, here's your chance to get out at 150, and off you go. But but that's Japan for you. They'll do things in their own way, and they'll pay the price for it, or they'll come out on top. But yeah, it was probably Kanda bidding it up at 152 anyway for everything he sold up up at the highest. Nice trade if you can get it. So yeah, onwards they go. Germany industrial production looking a bit sucky this morning. Let's go down to the right page first. Where are we? There we were there. Industrial production coming in at minus 0.4%, beating expectations. But we saw some of the other data showing more green shoots, but still a negative number there, down year on year as well. We've had ECB's DeCos out as well, saying that the central bank could revise upwards its growth predictions for Spain in June. Spain has been a bit of an outlier in terms of the economic picture, looking a bit positive, although industrial production was a bit stinky today. Came in, this is the non-seasonally adjusted number, down 11.3%, quite a big drop there. Month on month, again, doesn't show on this calendar, month on month came in at minus 0.7% versus positive 0.7% previously. So despite green shoots elsewhere, industrial production not looking too good for March. There may be some Easter effect in that though. But the cost says that they're going to potentially raise their growth projections up in June. He's obviously the governor of the Bank of Spain. Says rate for ECB says rates can be cut from June if the price path holds. The ECB is data dependent and can't commit to a specific rate path. The Riksbank, they went with a 25 pip cut, as some expected and some didn't. Their rate now down to 3.75, but the real news was in the forward guidance, where they said they expect the rate to be cut a further 2 times in the second half of the year. Though they did then throw in a bit of a counter, saying that the outlook for inflation is uncertain, and they see uncertainty on both the upside and the downside. Riksbank Sweden has come out since saying the decision was in line with the rate path from March. As we were saying yesterday, Kay, a bit of a surprise that the market wasn't leaning too far towards a cut. I mean, they touted this for the last month or so, and the data went their way, and they said the only risk to them cutting was other central banks, and the Fed wasn't hawkish, so surely it was a green light. It's still a surprise why so many thought it was a 50-50 chance.
Because of the currency, I think, Ryan. They since they were leading so dovish and announcing this cut, I think the market already took the currency a bit further than where they thought. So we had a little bit in between comments, keeping the market on its toes. But I mean, we got what was still the majority was still expecting for the cut. Sweden a bit weaker again. Running into a little bit of resistance there, but that puts them now in the G11 camp. That puts them now amongst the first cutter, apart from the S&P, what we saw from the S&P earlier. So, and also they had their press conference, and I was off desk, but if I'm not mistaken, they did not really panic too much about the currency. But yeah, I think they're giving us a bit of a green light here to slap the stocky further if unless we get like a big risk move on where the Scandies benefit from it. But I think we're going to find buyers on dips in all things against stocky right for the time being. I wouldn't go and pay up for it on stuff, but I think yeah, dollar stocky. I would suspect at one stage we are going to trade above 11 again.
Yeah, it's possible. But then they might have also taken a bit of the steam out of further weakness by, giving the forward guidance. Now the market knows exactly what to expect. If they'd have kept silent and then, cut, that would have been more of a surprise. So perhaps, as I say, they want to take a bit of steam out of it and not surprise the market too much. Let it know exactly what it wants to do, and hopefully keep the currency contained. Because it does sort of make it a bit boring now. We know they're potentially going to cut if the data goes their way. So you've got, I think we're probably going to switch, back to the other side of these pairs, dollar, euro, that sort of thing. But you're right, it could be a little bit of a dip buy for a while longer if people need to adjust. But anyway, we know what those guys are doing. If they do another 2 cuts that are taken down to 3.25%, which might be getting towards where they see the neutral rate, ballpark 2 to 3%, something like that. Maybe a bit higher depending on what inflation does. But it's going to be interesting. We're getting these banks slowly starting their cut cycles, and not many people are focusing on where they're going to stop. It's all about how many they're going to cut and when the cuts are going to be. Not many people are thinking, how far does the Riksbank cut to? And I think that's going to be the next trade, but that's also something to look at now if the market gets overly dovish on a central bank. And we've been saying it, since this whole cut thing started up. It's not how much they're going to cut, or it is how much they're going to cut by, but it's where they're going to stop rates. That's going to be the thing. No central bank is likely to be taking their rates back to zero unless obviously there's an economic shock or economies start really falling off a cliff. So there's limited space for cuts, shall we say that. Obviously, the higher some central banks are, Fed, BOE, the further they have to cut. Then you've got the others like the ECB, might only be cutting 200, 150, 175, something like that, compared to the Fed and BOE that might be 250, maybe 300. So there's still going to be divergences to play, but keep an eye on how much they are going to cut by to get to neutral. Probably not as much as the market expects. Over in the US, good old US of A, and we've had cash and carry spouting forth yesterday, saying that the housing market is proving more resilient to tight monetary policy than it has in the past. Housing market resilience could mean the neutral rate has been pushed higher. There he goes. He's talking about it, at least in the short term, he says. And because of that, he's modestly raised his neutral rate estimate to 2.5%. from 2%. So that's where he thinks Fed rates will be coming down to 2.5%. He says most likely scenario is that rates will stay put for an extended period. We would hike rates if needed, but it's not the most likely scenario, but we can't rule it out. So Friday's jobs report was softer than expected, but it wasn't soft. It says multiple readings on inflation is needed or are needed to be confident to cut rates. And then he came out with this line. It said in March, he jotted down 2 rate cuts for this year, but then says it's possible that will stay at 2 or go to 1 or go to 0 cuts. And cuts will come in June or September or not at all. So clear as mud, that opinion. They might get 2, might get 1, might get none. Don't know when they're going to start, or they might not start at all. So no clarity for anyone on that one. Morgan Stanley changed their Fed cut call. They now see the first cut in September instead of July, but still see 3 cuts. So that'll be 3 consecutive cuts when they come. What do you make of all that? cash and carry all over the shop.
Please, I mean, if I can say no comment, I feel a bit like Suzuki at the Ministry of Finance in Japan. No comment on such on such an intervention from his side. I mean, may not. He's on the relatively hawkish side of things. We know, but it's nothing new in there, right?
Yeah, no, exactly.
Mm.
So yeah, good. We can move on. Yes, I'm gonna pull the no comment card as well. The only other bit of data we got yesterday, I'm not going to show it because it's pointless. Was the Canadian Ivy PMI, which jumped to 63 from 57.5. Quite a surprising number there. Dollar CAD, I think, moved a pip on that data. Didn't even get a dip in that one. That's it. A bit boring yesterday. Oh, it was dead yesterday. Nothing else to add. Unless Kay, you got anything?
No, I was even off yesterday afternoon. I had stuff to do.
Oh, that's right. Yeah.
And running through what I missed, I came to the conclusion that I didn't miss much.
Nope.
Actually, I think that I said it already. The IB PMI is something that the market doesn't trade in Canada. It's quite volatile. I don't know what the size of the sample is either, but it's really completely ignored by the Canadian traders. So I think what nobody else looks at, we shouldn't either, until people look at it.
Yeah, exactly. It's a bit like the Michigan. If market's
Starts to
quiet,
be like the Michigan, yeah.
Yeah, if market's quiet, then the market gets something to focus on. It likes to trade it, but I thought it might have got a move because it was quite a sizable number, but no, nothing at all. So yeah, quickly moving on from that one. Right, so let's get stuck into what's going on in the world. As you've seen, dollar yen back above 155, potentially looking like it might want to motor on again. We're back in a bit of no man's land again above 155. They've got a few odds and sods levels, but I'm not going to trust an awful lot here. We'll see what happens up at the higher up if we get up there. But I think there's obviously the intervention risk still around. We don't know if they're going to come in and tap this. I would say volatility isn't, well, with 300 pips, since Friday, which is not really in the intraday volatility range for things, but they'll be keeping an eye on it. But they didn't intervene with volatility and speculation last week, the second intervention, so they might change their mind and how they want to do things. But yeah, I'm still in a bit of neutral mode. I would rather play it from the short side, but I'm not just going to jump in here. If we get a move up to that 160, which is a big level all on its own, then I might have a look up there, or if I get the sniper rifle out and fancy a few bits. So this one, we know the levels. We'll see if 155 becomes support. We know 152 is still the big level below, and then we'll see what happens if we get up to some of these levels and that 160. The dollar's looking a little bit stronger overall this morning. Not huge, but cables continue just to ease down and make a fresh low this morning, coming off those highs from last week. But it just feels, Kay, like things are just waffling around a bit rather than moving significantly for want of any big reason or anything. We know that this 124.50 is going to be important. We had it pulling up short in the 60s last week, end of April, beginning of May. So, this 124.50 is going to be a bit of a pivot line. If we test there and hold it, there's no big news. Might be a level that buyers will look at to pick it up from. Euro dollar the same, having a little bit of a pullback, but looking a bit firmer, shall we say, than cable. But then we know cable likes to run around a bit more. Bank of England's obviously coming up on Thursday, so that may be a bit of an influence for that one. 107 for me, the level down here. If we get a test there, see what happens. I'm really only looking to maybe scalp off these levels for want of any big news or data, or lack of. at the moment. I'm not really willing to go out on a limb on any trades. Dollar CAD is one I'm in. I've had another little slice up here. The longs I took on Friday. But again, more work to do. Got an area 70s, 80s up here to get through. Then 138, 38.10. The big level though is the 138.60s, which we've had a few tries at getting over, but haven't done so. So as you can see, it's a age-old area of support and resistance. So that's the big number above. In the meantime, it can wander around to its heart's content. Euro sterling, quick look at that one. Let's zoom it in a bit, as we always need to do. Another mooch up to the 86s. Again, it's not a level that we've managed to get and hold above for any significant time. But we're up here, this little zone, 86, 10, 20. Need to chew through that. Maybe then we get on the move up to my zone up here, which failed twice the last time we were up here, and took that move all the way back down again. Still no fundamental reasons why this should make a big move either way. So just playing the range for me. I'd like to add it on the lows into 85s and start offloading them if we get up here. So no change for me, still core long. Stocks topped out. S&P topped out at the big figure pretty much. I was watching this one yesterday. Took all day to chew through this zone. And then we get to the big figure and one test and it gets kicked back again. And now we're just going sideways in this zone. But it remains fairly bullish. It's been quite a decent move. It's on a bit of a grind, which suggests we could be continuing moving higher. But we know where the marker's set now, into that 5200 area, 5220s, the next important level above that. Okay, I'm going to throw it over to you for some inspiration now.
Oh, thank you very much. Not that I'm much more inspired right here and now, but to come back on your, I've got the dollar Swiss up here, but for Ali. But to come back on your sterling, I think the what we've seen, I think I mentioned it yesterday as well, is already, I think the market, well, worried is not the right word, but trying to speculate on the fact that we may, instead of having a 7-2 vote, a 6-3 vote, and Bailey all of a sudden siding with the potential cutters, or hinting at it. And I think that's what we saw in the sterling over the past 24, 36 hours, you know, from when we hit those highs on what was it, on Friday or so. We spent the start of this week correcting it. I think we'll see a bit clearer on the sterling come tomorrow. But what I would like to point out though is that this base here, this overall base here in euro sterling looks more and more solid to me, really. And if there is any dovishness tomorrow out of the Bank of England, I could really imagine that we go for a walk higher, perhaps back into those levels that we saw back in December, even, you know. Let's say it wouldn't surprise me, and because this seems to now getting to be a really, really, really good base. Of course, in turn, if we would see a break lower, it's going to be equally important as well. But it really feels basy to me because we've been trying since January to get below here, and we are now May, and we're still holding, and all attempts to really break below have failed so far. So it does seem to be a really, really good base. And as you already said, and as we already said, perhaps the Bank of England, once they start cutting, will be a bit more dynamic than for instance, an ECB. And that could then take this pair higher again. It's just a feeling that I have, you know, on all things sterling right now. And one of the reasons why cable is heavier than the euro dollar, for instance, putting this euro sterling a little bit higher. It's just a feeling that I have that the market is waiting for a bit of confirmation tomorrow of the Bank of England dovish land to take the sterling a leg lower. That's now the feeling that I have, because the sterling hasn't benefited from the last leg higher in the equity markets. And usually it is a currency that likes risk, and it did not enjoy any of the positive risk environment. Right, Ali, you are long dollar Swiss. It seems that, yeah, and I found this as well. This dollar Swiss is trading along this trend line. Once it's above, once it's below. But the main one is still, I think, just here around 90, 90, 10, 90, 15. But we did hold this trend line so far, right? The on the trading. It is, how should I say? I think it's still a bit undecided. We need to get back above 1990 and start to move up again, up in that 91.35.50. But it's still my base position. I still have some in. I still have a little bit of Swiss short via dollar Swiss and euro Swiss, because I still like it right now. After these spikes, the way it comes back, it still looks okay to me. Yeah, so you can hide your stop below this level. Why not? I mean, this is a contained risk play. Let's say this is quite okay. And if in by any accident some US data would start to turn sour, although today we don't have much that is going to really move the dollar. We do have Jefferson speaking. For the rest, there is nothing. Those MBA mortgage rates, they haven't really moved the needle too much. We will have a 10-year note auction later on today, and then Cook speaking. But all else equal, it does look still like those lows that we've been building here are solid enough right now to contain the dips in the dollar Swiss. So yeah, I wouldn't completely disagree with it. The one, of course, that I've been then looking at, and I've even been looking at the very long term in this Euro Stoxy. And if you look at the long term, this has really been a quite gradual rise higher. So going ahead, the ECB has, I wouldn't say freed up the move higher, but I do think that we are going to see bids on dips in Euro Stoxy, unless really risk flies and everything is and the euro actually dollar goes up. That means dollar Stoxy could go down quite quickly with very positive risk. But I do think that the Riksbank gave us a little bit of a green light to buy dips in things against Swedish krona. So 1160 is one, and then I would really pay attention where the 200-day moving average lies at 1150. This is now a bit of a, wouldn't call it a magic level, but it's a level that I'm going to keep a very close eye on going forward. It is 2% away from where we are, but we see here that we see in a relatively short span of time that we can see those kind of moves. So I'm just keeping my eyes wide open to see if there's an opportunity there. And if you look at dollar Stoxy, I need to go on to the 4 hours. This is actually moving in some form of a channel. We have on Friday tested the bottom end of the channel. We have retested it on Monday, and we are bouncing. So this is your support here around 1080, 1075-ish, and in the low 1070s. This is something, if I would see a dip, I may get involved here around 1080. It's about 1% away, I know, but you never know. And perhaps hide my stop anywhere below this little activity zone, which is also a fib area, 1070. If 1070 breaks, then something may be changing. But again, based on the Riksbank, we may just see this thing gradually creep up again to levels above 11. That's my feeling on this one right now. Does anyone else have to? Yeah, Angela, you are right. I mean, if you look at the euro dollars heartbeat, it's not a great thing. I think euro dollar is really the tool to do everything else. So you can do euro crosses, like and euro Aussie. Well, I'm going to have a look at the euro Aussie because we are on an interesting level here. I saw this one here, and we saw the break. We actually started to really break very well, but we are back to the resistance area on this euro Aussie. If this would become a real head and shoulder, we should stop here at 163.60, give and take 60.70. Okay, we should really stop here and start to turn lower, but I don't know. I tried. Well, I was short towards the end of the month, and then I took it back. This was it was a pretty decent trade, but I tried it again yesterday around 163.10, and I gave up this morning around 163.35 because it didn't look like I didn't look like the look of the Aussie dollar breaking back below this 65.80 level either. So I really went out of it. But we are, I think, in an interesting zone here, Euro Aussie. You can try it here, but you keep your stops really very tight, depending on your feeling on either one of the currencies, whether it's the euro or the Aussie. You can trade it here. I'm going to just watch the game. Perhaps if we start to get back below 163.5 and then hold below, perhaps going to try it again and put my stop right above there. But I'm really going. This is going to be a very low risk, very low risk trade. This one. Okay. I'm at the end of what I wanted to show today, Ryan. I'm going to talk about the MEX tomorrow. We have Mexico tomorrow. For those interested in emerging markets, we have Brazil today. They may be cutting. You took the other side, saying that you're long, Angela, right? From below, or that's what I understand. Oh, okay, nice one. Well done. So yeah, I'll talk about Mexican peso tomorrow. Brazil tonight, for those who trade emerging markets, they're expected to cut rates. Yeah, well done, Angela. I guess it's the right level to get out, or at least take a decent chunk off, because the importance of the level there in that euro Aussie, right? Okie dokie. Final one, because dollar rand broke and then went. I said this was the extra level, right? If it goes below 1838.5, 40, it may be curtains for dollar rand. And look what happened. It exactly tagged it. I think here a good few people have been stopped out in this level, and what happened? We are already starting to bounce. Okay, it's going to be politically driven. It's going to be commodity driven. Commodities, we are seeing them starting to come up a little bit. So it responded, but it also responded quite nicely on the tech level. So that's also a good thing for the rand. So keep this level in mind for those who trade emerging market currencies. And with that, Ryan, back over to you.
Thank you very much, mate. I will go back just quickly for one thing.
Joao is asking about oil.
Yeah, exactly. There we go.
It's dripping.
Look at that.
It's leaking.
Yeah,
it's leaking.
Oil right on there.
It's leaking, Joao.
Yeah, and Ali's asking as well, with a dollar CAD influence as well. I mean, I said this yesterday. I was speaking to Michael Brown on the trade-off as well about we were on this fib and it was holding down into this fib. It's broken down now, and the thing with oil and CAD is that the correlation's been on and off. You can't trust it at the moment, but we're in a quiet period right now this week. So, the market's taken a bit more notice in what's going on or the correlations are coming back in for want of anything else to trade. No surprise that dollar CAD made a high round about the time that this made its low and has bounced, and dollar CAD's off a few pips. So there is a bit of oil influence going on here now. But keep an eye on this break of this 50 fib, this, sort of 77.5 level. If we're holding that, it's going to continue to probably head lower. Support, we've got a couple of areas. We've got that old low there from March. a few bits and pieces around here, but otherwise this 61.8 fib could be, or would be, the last line in the sand for this rally that we've seen since the latter part of the year. OPEC wafflers are out as well, talking about what they're going to do, maybe extending production cuts and that sort of thing, but the market's taking not a blind bit of notice to that. I don't know if there's a bit more risk, geopolitical risk in this one, with this stuff going on with Israel and Rafah. It wasn't having too much of an influence, but now things are really kicking off there. We could be having that. And also keep an eye out for Bidden trading oil, picking it up for the SPR. He's probably got his bids lined up somewhere along the lines down here. So that could be an influence as well. But yeah, for the moment, yeah, we've got a bit of a breakdown here of this 50 fib, and that could possibly be your pivot level for the moment. As I say, if we come back, test it around there, hold it, then we're probably on for more downside, and that in a quiet market will probably see the Canadian dollar weakening as well. Right, let's have a look. Any last things before we call it a day? Nope, not much. Oh, we'll have an early one then, Kay. We can all go back to bed for half an hour and until we have to get up for FA.C.E. So thank you, everybody, as always, for coming to the Flow Show, following us here. Always a pleasure. Thank you, Kay, for all your valued insights as well. BOE day tomorrow, so a lot to talk about tomorrow morning. Have a good day, everybody. We'll see you all tomorrow.